I think it is 9:30 now, and we have had a quorum roll in based on my count up here. So we will call the first meeting of this interim joint committee on banking and insurance to order at this time. If everyone would please move towards your seats, silence your cell phones. Madam Secretary, we'll start with you calling the roll, please.
Senator Rocky Adams, Senator Douglas,
Present.
Senator Girdler, Senator Howell, Senator Neal, Senator Schickel, Senator Smith, Senator Storm, Senator Turner, Senator Yates, Representative All.
Here.
Representative Bentley, Representative Bray, Representative Duval,
Present.
Representative Fraser Gordon, Representative Gooch,
Here.
Representative Justice, Representative Lewis,
Here.
Representative Lockett,
Here.
Representative McPherson, Representative Pollock,
Here.
Representative Rorix, Representative Roberts,
Here.
Representative Smith, Representative Stevenson, Co-Chair Carpenter, Co-Chair Meredith.
Yes, ma'am. We do have a quorum and are duly constituted to do business. Do any of the members of the committee have a guest they'd like to introduce today?
I do, Mr. Chairman.
Senator Howell.
Thank you. I have my daughter, Mary Browder, with me. She was nice enough to spend a couple days with her daddy before she goes back to school anyway.
Mary Browder, good to have you here today. I hope you take him on the golf course while you all are here.
That was part of the ransom.
Any others? Seeing none, we'll proceed with the business that we have before us today. It's a little odd that we would normally do this, but we do have two administrative regulations that we need to do some amendment work on. Staff had flagged some minor discrepancies that needed to be addressed, and I think all members of the committee have received summaries of those prior to the meeting. But at this time, if we could have the folks from the Department of Insurance come forward, we will address 806 KAR 006072 first. If you would recognize yourself for the record and make a brief explanation of what those are.
Abigail Gall, Department of Insurance. I'm an executive advisor to the commissioner. So this regulation, I don't know if you've read through it, but it's fun stuff. The amendment was just a technical amendment to fix an internal citation within the body of the reg.
Do members of the committee have any questions related to this issue? Seeing none, do I hear a motion to approve the staff amendments? I've got a motion from Senator Schickel, second from Representative Lewis. All those in favor say aye. Any opposed? The amendments have been adopted. Thank you, Abigail.
Thank you all.
Now, if we could have Commissioner, I guess you're going to take this one yourself. If you'd come forward, identify yourself for the record, and tell us a little bit about the amendments in 808 KAR 016010.
All righty, thank you. I guess the amendments are just lining up the renewal dates for student education loan servicers. I think there was some discrepancy, I guess, in the renewal periods in the statute, so we were just lining those up to make sure that everything was in line.
Any questions related to those? Seeing none, do I hear a motion to approve the staff amendments? Motion, Representative Lockett, second, Representative McPherson. All those in favor say aye. Aye. Any opposed? The staff amendments have been adopted. Thank you, Commissioner. Now that we have the voting business behind us this morning, we will get started with our presenters that we have for today. If our folks from the Kentucky Bankers Association, Ballard Cassidy, and Dr. Charles Skip Hedgeback, President and CEO of City National Bank, would come forward. You all, and John Cooper, if you all would identify yourself for the record, please, and then if you all would proceed with your presentation.
Mr. Chairman, thank you. My name...
Ballard, get your microphone there.
Is that,
Turn on. There you go.
is that better?
No.
Is it on?
There.
There we go. All right. Mr. Chairman, members of the committee, if you don't mind, I will introduce the entire group up here this morning. My name is Ballard Cassidy. I'm with the Kentucky Bankers Association, and to my farthest right, we also have John Cooper, who is the legislative consultant, Kentucky Bankers Association, with us here today. However, it is our third participant that I take great honor in introducing to you today. To my immediate right, Dr. Charles R. Hedgeback, or Skip as he's called within the banking industry around the country and by his customer base. You have Dr. Hedgeback's vita and resume in front of you, I think. Should have. And additional personal history, so I will not waste your time going through that again with you here this morning, except I would like to add something that isn't in the resume. In earning his PhD in economics from Indiana University, Dr. Hedgeback did his dissertation on causes of bank failures and their predictability based upon financial performance. He is that rare individual in our industry that possesses both academic and practical operational experience, and he uses it well as the CEO of City National Bank, which is consistently regarded as one of the most profitable bank franchises in the United States, while at the same time maintaining one of J.D. Power's highest ranking for customer service. It's my privilege to present Dr. Charles Skip Hedgeback.
Mr. Chairman, members of the committee, thank you for inviting me to speak to you today, and thank you for your interest in the health of the banking industry in Kentucky. The primary purpose of banks is to provide financial intermediation, which is the critical component of a strong and vibrant economy. A solid banking industry is important to the state's economic success. In March and April of this year, the U.S. banking system experienced the second, third, and fourth largest bank failures ever in U.S. history. The first of these to occur, the failure of Silicon Valley Bank, occurred on Friday, March the 10th, and rocked the industry. The table I provided tells you that Silicon Valley Bank was based in California and had assets of over $200 billion, but operated from only 12 branches. The second failure occurred 2 days later on Sunday, March 12th, when the FDIC announced that Signature Bank, a $110 billion bank based in New York City, would be acquired by Flagstar. First Republic Bank, a $213 billion bank, the second largest bank to ever fail in U.S. history, failed on May 1st and became part of J.P. Morgan Chase. The failure of these three very large banks highlights the challenges that the entire banking industry is facing. Today I'll describe those challenges, why they're important to banks in Kentucky, and why they should be important to you. But first, it's important to say that the banking industry is really better positioned than might be implied by these very large bank failures. There's a saying that if it grows like a weed, it's probably a weed. These three grew very fast. They were definitely weeds. Luckily, they were also outliers. But the factors that did them in are real, are impacting Kentucky banks, and will likely continue to worsen in the year ahead. I think it's important for you all to understand how community banks work. Banks operate by accepting deposits, and the most important deposits we accept are those in checking accounts, which provide the critical lubrication that the economy needs to function properly. Banks pay interest on some of these deposits. Banks then deploy these deposits into earning assets, which are predominantly loans on which we charge interest, and to a lesser extent, we deploy them in investment securities, which also pay us interest. The difference between what we earn on loans and investments and what we pay for deposits is something we call net interest income. And that spread between loan rates and deposit rates is the primary driver of bank earnings. It's also important to understand that banks operate with relatively little capital as compared to most other businesses. Banks have razor-thin profit margins as compared to most businesses. Bank profit margins are generally about 1% of assets. And it's a fundamental principle of corporate finance that businesses with thin profit margins must operate with high leverage. Often less than 10% of a bank's assets are funded by shareholder equity. And please understand, more equity is really not a choice for businesses that have thin profit margins. Banks must be highly leveraged. Of course, operating with high leverage also implies that you are taking risk. So banks, having thin capital, must be especially careful with asset quality. And when banks fail, it is usually due to bad loans. But with a balance sheet of illiquid loans funded by highly mobile deposits and very little capital, banks are also exposed to deposit runs. Prior to 1933, when the FDIC was created, bank runs were very common. So banks make money by accepting deposits, making loans, and carefully managing loan risks and potentially managing the risks of deposit runs. So let's go back to the spread between loan rates and deposit rates at the beginning of the COVID crisis. Normally, the spread between the rates earned on loans and the rates paid on deposits is 3 to 4%. With that spread, banks earn enough to pay their operating expenses and still make a reasonable profit. But without sufficient margin between loan yields and deposit costs, banks will struggle. And that's exactly what happened in 2020 when COVID pushed the U.S. economy into a significant economic downturn. As the stock market crashed and the U.S. economy tumbled toward a recession, Congress approved the PPP loan program and trillions of dollars of stimulus checks, trillions of dollars. Those dollars were then deposited into the banking system, deposits which banks could not easily deploy into loans when the economy was so weak. At the same time, the Federal Reserve lowered interest rates to almost zero in order to try to sustain the economy. As interest rates fell, consumers refinanced their mortgages. Today, the majority of residential mortgages in the U.S. are locked into long-term rates under 4%. And businesses refinance their loans into lower rates as well. So the margin between loan yields and deposit rates got smaller, and banks became less profitable. The difference between loan and deposit rates during 2020 fell by 20%. Profits fell by 40%. With trillions of dollars on the balance sheet and no new loan demand, and short-term interest rates the lowest in U.S. history, banks had to do something with all those new deposits to bolster earnings. Unable to make loans, they did the only thing really they could do. They put all those deposit inflows into long-term investment securities. But rates were very low. For example, a 10-year Treasury bond during 2020 paid 1.6%. Investing in long-term bonds put an earning asset on the yield, earning 1.6%, but also locked that rate in for many years. So that was safe and smart because the Federal Reserve told us that rates would remain low for years. But the Fed forgot what Milton Friedman taught us in the 1970s, which was too much money chasing too few goods creates inflation. Trillions in fiscal stimulus didn't create new cars, it didn't create new houses, more food, more cell phones, or more gasoline, it just created inflation. And by 2022, inflation, as we all know, was rampant. That caused the Federal Reserve, despite what they'd said before, to raise interest rates really at the fastest rate in all of recorded history, which was an uh-oh for banks. Remember that before rates went up, banks had already locked in loans and investment securities at all-time low rates, like 1.6%. Those loans and investment securities remain on our balance sheets today. Banks had locked in loans and investments using trillions of new dollars of deposits, which came in during COVID, paying little or no interest. And normally, as interest rates rise, banks increase the rate they pay on deposits. But banks couldn't do that this time because the assets they have on their books are locked into extremely low-paying loans and investments. So banks have increased deposit rates only slowly. For example, in Kentucky, this week, the average rate paid on a money market deposit account, if it has a $100,000 balance, is 0.6%, less than 1%, 0.6%. Money market funds offered by brokerages like Fidelity and lots of other places pay close to 5%, 8 times as much as Kentucky banks are paying for a $100,000 deposit. As a result, some depositors go looking for higher rates and transfer their funds elsewhere. Not all depositors, of course. Phil and Rosie didn't move their $1,000 checking account, thank goodness. But you can bet that businesses and individuals with very large accounts did. And that created a problem for banks like Silicon Valley Bank, Signature, and First Republic that preferred to bank rich people and megacorporations rather than small businesses and ordinary citizens. On top of all of that, all of those bonds which banks bought at rates below 2% and which won't come due for years are now valued at far less than was paid for them. And a sad fact of accounting, GAAP accounting requires that banks recognize paper losses on investment securities by immediately reducing the book value of capital, forcing some banks to show capital levels look really, really low. Declining capital levels tended to hit those banks that had the largest inflows of deposits in 2020 and 2021, and subsequently bought the largest amount of fixed-rate investments at just the wrong time. Silicon Valley, Signature, and First Republic all grew like weeds during those years at a compound average growth rate of 20 to 40% a year. That growth came from very large deposits, from very large corporations, and from the very wealthy, who by definition are going to be the most interest rate sensitive customers when rates go up. At these banks, as rates rose, customers demanded better yields or left. On the table I provided you, if you look at the bottom row shows that the average cost of deposits for these banks in December of 2022 compares it to our bank as a representative bank, a community bank, and you can see that these three banks had much, much higher costs of paying for deposits than did most community banks in America. Those high deposit rates pinched the earnings of these three banks. At the same time, these three banks experienced huge deterioration of their capital as they accounted for the falling value of the long-term bonds that they bought. So the appearance of low capital and the declining profitability led the shareholders of these banks to become concerned about their profitability. And because shareholders were concerned, uninsured depositors became concerned. Insured depositors, of course, couldn't care less because they know they're insured, but the uninsured ones did care, and all it took was a little bit of a spark to create a deposit run. Once ignited, uninsured depositors ran for the doors. Some of you, and I'm learning that anybody under 40 doesn't know this movie, but some of you will remember Mary Poppins. When one little boy couldn't get his toppins from the bank, other depositors quickly lined up and withdrew their funds. In 2023, though, you don't have to line up outside the bank to get your funds. You open up your cell phone, you hit go, and the money is transferred very, very quickly. And so once the run started, these banks experienced massive drains of their deposits in just a few short days. These three banks knew they had few insured depositors. They should have been more conservative about their risk-taking as a result. They weren't, and they paid the price. Every bank in Kentucky is struggling with the same challenges as these three banks were, but to a lesser degree. First, loans and investments on our balance sheets are locked in at low rates of interest. Nationally, banks are in less than 5% on their loans today, and asset yields are only going to go up very slowly as loans reprice. Second, depositors are seeking higher yields and are moving their money out of the bank, forcing the bank to replace those lost deposits with higher cost funds at market interest rates. Or in some cases, the customer's just moving funds from a low-paying deposit account in a bank to a higher-paying account at the same bank. I'll give you an example. Community Trust in Pikeville on my rate sheet tells me that they pay 0.2% on a money market account. The national or the average in Kentucky today is 0.6, but Community Trust is paying 0.2% in Pikeville. In Pikeville, you could put your money in a 7-month CD at 5% at Community Trust. Well, why not? Moving into the 7-month CD picks you up 4.8% of additional interest income, but subjects Community Trust to higher interest expense. Customers are moving their money to higher returns, and this is just going to continue day by day, week by week, month by month. Third, higher market interest rates have lowered the value of low-yielding investment securities owned by Kentucky banks, and those losses, as required, have been booked as a decrease in capital. Lower capital means less ability to lend, and it means likely more regulatory oversight, neither of which are good things for banks. Fourth, the Federal Reserve's goal of reducing inflation necessarily means slowing the economy, even to the point of a recession. Recessions means fewer loans, and recessions tend to result in higher loan losses. which requires banks to set aside earnings for potential or real loan losses, further constraining the ability of banks to lend. So to be clear, at least so far, Kentucky banks as a group, and in fact banks throughout the United States as a group, have remained solidly profitable. So far, banks as a group have not experienced any decrease in asset quality. So far, there remain very few banks identified as problem banks by our regulators, but stresses continue, and bank stock analysts tell us they generally expect bank profitability to decrease throughout 2023 and throughout 2024 as a result of a weaker economy and repricing deposits. So any banker you know today is worried. At this stressful time, what do Kentucky banks need from their legislature? And these will be my opinions. They're not necessarily the KBA's opinions or Ballard's opinion. But first, I think legislators need to understand the unique role that banks play within the economy. Banks intermediate between depositors who need immediate access to their funds and borrowers who want long-term financing. Banks take risk when they intermediate between borrowers and lenders. So in order to take that risk, banks require a certain level of economic stability to make the risk manageable. High inflation or high unemployment, either one can threaten bank survival. Government must seek to provide a relatively stable economy. And while the Kentucky legislature can't primarily be held responsible for economic stability, they can contribute to creating a stable business environment by ensuring fair legislation and fair regulation. I'll give you an example from this week. The West Virginia Economic Development Division announced plans to provide financing for West Virginia customers who need business equipment at a 3% interest rate, way below market interest rates. You know, that's great for West Virginia businesses that need to borrow for equipment, but it's really bad for banks. These are loans that banks would like to make. In fact, they're the bank's bread and butter. Fewer loans means less profit at a time when most banks are quite worried about the future. Not the right move on the part of the West Virginia legislature, in my opinion. Second, I think legislators need to understand the unique role played by small community banks as compared to the role played by larger banking organizations. Banks like J.P. Morgan Chase facilitate large business loans, which small banks wouldn't be able to underwrite. Banks like Chase also do a lot more than simply make loans and accept deposits. They operate in many complex lines of business. And there is a role for these banks in our economy, although it's my opinion that generally they're far bigger than they would need to be to serve that role. But small community banks typically serve small businesses, and their business model is simple. We take deposits and we make loans. For small community banks, there generally aren't other ways to make money. Particularly for small banks, excessive regulation and the cost of keeping up with technology makes it tough to be a small community bank and be competitive with larger organizations. So in my opinion, government, both at the state and national level, needs to be proactive in their support for small banking organizations, which I define as anything under $20 billion in assets or less than 300 branches. You can debate what that definition should be. Third, legislators in Kentucky need to be supportive of community banks operating in rural markets. Lexington and Louisville are well served by many, many banks. Customers in Nicholas County and Owsley County are not so well served by lots of banks. In fact, in Nicholas County, there's one branch, and it's mine, one branch in the entire county. These communities need access to banking services, while the large banks have no interest in providing those services in rural communities. Absolutely, they don't. In my opinion, legislators need to be proactive in finding ways to support community banks who operate in rural parts of the state. These banks face all the challenges of being small while also facing an additional challenge of finding adequate talent and staff to lead their bank today and into the future. In conclusion, particularly at this time when banks are experiencing serious challenges and facing lots of uncertainty about the cost of retaining our deposit base, please avoid doing anything that makes it harder to be a bank. The challenges our industry is facing are real and will weigh on us heavily for at least the next 2 years. Thank you.
Thank you, Skip. And we do have a few questions from members of the committee. We'll start with Representative Lockett.
Thank you, Mr. Chairman. I have a couple of questions for you, and I will be the first to admit I'm not a banker. I'm actually a financial advisor, and so my role at this point in time, I'm actually glad that interest rates are, of course, where they are. But in terms of your presentation, it kind of begs the question for me. You mentioned that at a bank, say a money market account, on average pays about 0.6%. For my clients right now, as you mentioned as well, I can go and get a brokerage account paying 4.755% on average. And so my question, the first part of my question is, what is the line between kind of as a local bank to say, okay, we understand that we are losing clients because of a lower rate, but I also understand the profit margin that you have to operate under. So where is the line of saying maybe we should raise our rates to keep these clients from leaving while at the same time watching our bottom line?
So okay, I'll give you the truth there. In a normal world, had the government not put $5 trillion onto the balance sheets of the banking system, when rates began going up, banks would have followed relatively quickly because they would have had to. With $5 trillion of additional deposits, when rates started going up in mid-2022, banks didn't have to. They looked at their balance sheet and said, we're flush with deposits. We don't need to pass this along. We're not going to do it. And all of those decisions are, of course, made uniquely and individually by each bank for their 4,000 banks in the country. But they all saw the same trends. And so market rates went up, banks didn't raise rates. Market rates went up, banks didn't raise rates. And it got to the point that you realize that market interest rates are 3%. You're still paying 25 basis points. You say, well, if we reprice that 1.5% for $1 billion in deposits, that's $15 million of earnings is going to disappear. How many of these accounts are going to leak out? And we'll have to replace those at 5 or 3 at that time. So there's a balancing act there. That each bank has to deal with, and each bank has a different customer base, right? So if you're Silicon Valley Bank, you had to reprice very quickly because all of your customers were big. All of them were rate sensitive. In a community bank, that's just not true. We've looked at our deposits for every product by the tier of the account balance. And you can see that the deposits that are leaving our bank, and we had relatively low losses of deposits in the last 6 months, are in the highest tiers. So they're people that have money in a checking account that may be over $1 million. I'll give you an example. I had dinner last night with a client. He happened to mention that he had personally, not the business, had $1 million in the checking account that he'd set aside for a business transaction that, as yet unnamed, surplus money. And he said, I ought to be probably putting that to work. My guess is today he's calling his representative at Citi and talking about where he can move that to a better yield. So at Christmas of last year, I suspect most bankers were very, very worried about what was going to happen because our assets are locked into very long-term rates. The market interest rates are rising. We were sensing that we would have to do more and quicker, and we were worried about what that meant. Today, in the summer of 2023, I'm relieved that we didn't have to do what I was afraid would result in many banks earning nothing in 2023. But dollars every day are walking out of the system. If you have a franchise like ours with lots of small accounts, there's no real incentive for those folks to move. So for most community bankers in Kentucky, they're not going to be at risk of people wholesalely moving. There are going to be some who are. I'll give you an example. My son called me in January and said, Dad, what am I making on my regular savings account? And I said, well, you're making 5 basis points, Robbie. And he said, well, I think I could get more at Fidelity. And I said, you could, Robbie. And he said, well, I'm going to move it. And I said, okay, Robbie. And pointed out to him where he might want to look on the Fidelity website to put his $4,000 to better work. Robbie happens to be an unusual person who's rate sensitive with $4,000. My customer last night has been for a year sitting on $1 million in a checking account earning nothing, and not just now beginning to think about what to do with it. So it's does that answer your question?
Yes, sir, it does. And kind of as a follow-up to that, you mentioned your kids. I've got two kids, and they are 20 and 18, about to be 21. And so I've been trying to tell them and teach them about saving money and banking and so forth. And neither one of them want to at all walk into a local bank branch and do banking. They want to do it all online. And so they go to a Bank of America or Ally Bank or something like that. And even when they were looking at car loans, the same thing. They did not walk into a local bank branch. So as you kind of look down the road in terms of the future of local banking, how do you think a generational impact in terms of a generation that does everything online and doesn't walk into a place of business? They buy all of their goods on Amazon. They do all their banking online. How is that going to impact the local banking, and what can you do to adapt to that?
So that's a really great question. There's several different things that I think of in that regard. Absolutely, customers today are going to be demanding more technological savvy. J.D. Power, the J.D. Power organization, has ranked Citi out of the last 6 years the best in customer service 4 out of those 6 years, and not too far down the other years, in a 5-state area, including Kentucky, West Virginia, Ohio, Indiana, and Michigan. One of the things we know from J.D. Power is that if you ask customers, why did you open an account at this bank, they will tell you the most common reason is because of the branch location. But they will also tell you that every year the demand for technology grows. That what it means to deliver great customer service to customers today is far more dependent on technology than it was 10 years ago. And every year it's shifting. And so that puts pressure on small community banks, because small community banks struggle to have the technology that a JP Morgan Chase could have. Citi's online banking presence is very strong. Mobile banking presence is very strong. Not as good as Chase, not as good as B of A, not as good as Wells Fargo. We can survive. We are growing checking accounts in every region every year, even regions that don't have population growth, and even regions where we already have large share, because we do have good technology. But for the smaller community banks than us, that's a real issue. And it isn't going to go away, which is one of the reasons I believe that the legislature, both here and in D.C., need to be supportive of small community banks and rural banks where they can, and proactively supportive, because they've got pressure. Absolutely, they do. I think your kids and my kids come to a real bank about the time they get their first regular paycheck, and then they've got to deposit it someplace. But it may be in an online presence, and that's just a challenge. There are not going to be 4,000 banks 10 years from now. There's going to be less, because there's pressure on those small banks, and particularly on the small rural banks.
Yeah.
Representative Hall.
Thank you, Mr. Chairman. Thank you, Doctor, for the presentation. Very educational and thorough. I'm going to, in the interest of time, skip my joke about George Bailey and the run on the banks and go straight to my question. With the uninsured deposits in these other banks being at 90, and 70, and then about 15% at your local bank, is there some kind of database, or I'm interested in knowing what is the Kentucky bank that has the highest uninsured deposit percentage, and would that be one of the indicators that puts it most at risk, in your opinion, for a similar type situation?
There is a database. That data comes from bank call reports, which are required to be filed by every bank in the country every quarter. So there is that database. I'll see if I can't get it for you. I've got a financial analyst who is a whiz at pulling data out of there. It would be my guess that there are no banks in Kentucky that have large amounts of uninsured deposits. It just isn't the nature. You have Republic, Stockyard, Community Trust, Central, as banks that are headquartered here, People's Bank of Marietta, West Banco, City, that are not headquartered here but have significant presence here. None of those are going to have large amounts of uninsured depositors. They cater mostly to small businesses. There are ways to insure customers who have more than $250,000 using various naming techniques, and then using the CEDARS program to get money, additional FDIC insurance. So most small businesses, most medium-sized businesses, most families can get themselves fully insured. Silicon Valley and First Republic and Signature grew like crazy. They went after, they attracted. We read in the paper about a $3 billion. Who has a $3 billion checking account?
Not me. I got one quick follow-up. Have you seen any states enact any kind of legislation that actually put a cap or a restriction on the amount of their banks in that state that could have an insured deposit as a percentage of the overall balance?
No, sir. No.
Okay.
Dr. Hedgebeck, one, and your presentation was very thorough, and I just want to highlight two things. The first is obviously talking about the Silicon Valleys and these other banks that failed, and the chasing of the deposits that they had and the growth that they had. Can you talk just a little bit more about kind of the organic, non-chased growth that happened because of that $5 trillion put in the system, just seen by the average bank out there?
I'm not sure I understand the question.
Do you mind?
Go ahead.
I'll take a shot, Mr. Chairman. It's said that we threw during PPP about $5 trillion to fill up a $2 trillion hole. Is basically what we did. So where did that money go? That money went into the banks in the form of deposits, and it sat there. People didn't need it. They couldn't get out and go shopping. They couldn't go on a trip. They couldn't buy clothes. It just sat there. And it refers back to what Dr. Hedgebeck was talking about, banks having to do something with that, and that was go to long-term investments. Who would have ever thought that buying a treasury bill would have been dangerous? Not in my lifetime, and I've been around a while. So the average bank out there right now is subjected to that huge amount of influx of deposits with no loan demand. The loan demand left when you did the PPP loans. You lent money to every customer you had at 1%. So they've got a 1% loan. All of a sudden, they're gone. The pandemic is gone, and now you're sitting there with a bunch of money you need to get to work. Who do you lend it to? And I think those are the questions that Dr. Hedgebeck is trying to answer.
And I just highlight, and again, I'm a banker by trade. That's what I do for a living. Our bank had grown somewhere in the 2-3% range on average every year for the last couple of decades, except for when we might open a new branch or something like that and went into a new area. We saw about a 15 to 20% increase in our deposit base and our asset base, not based on any actual work we were doing to try to attract new deposits or market to new deposits. That was just organic growth in the system that occurred because of the influx of federal dollars that were coming in. And I think what we experienced was not uncommon amongst most banks throughout Kentucky and throughout the nation. So there was a huge amount of increase in that base just because of the federal intervention that occurred.
Absolutely.
And my second question, just quickly, and you highlighted this some too in just the brief explanation, but can you highlight a little bit more about what the percentage of small business lending is done by what we consider community banks in this country versus being done by the Chases and the Bank of Americas and folks like that? And highlight what a huge portion of the capital being contributed to small businesses is by the community banking system.
And there, of course, are different definitions of small, right? So my definition of a small loan is different than Chase would define a small loan. Chase might say anything under $20 million is a small loan. But any way you slice it, the small loans in America are not getting done by Chase. They're not getting done by Wells Fargo and Bank of America. They're trillion-dollar banks, and that they can't. I'm not sure that they even want to do it, but even if they wanted to do it, they can't do it because they can't grow earnings at $10,000 loan pops. They have to be thinking about a $500 million loans, a $5 billion loan. So I would say almost all small loans are being done by small banks, and unfortunately, small banks are going away. And getting merged out of existence by the challenges of technology, the challenges of finding staff, the challenges of dealing with regulation. And government can make a difference by trying to proactively look for ways to help those small banks, and I'll say again, the small rural banks, to be able to not have so much regulation, which costs a lot of money in people. A compliance officer, a BSA officer, all those things are really expensive for a small bank, and we need to reduce the overhead put on the smallest organizations so that if they cease to exist, they cease to exist only because the owners of that bank no longer are interested in doing it.
And you led me into a perfect segue of something I wanted to ask you about that I didn't put on your list. Could you then educate the committee a little bit about the effect of what the federal 1071 rule, if it's implemented, could have on that?
I'll let you go there.
Hallelujah. The 1071 rule, for those that are not familiar, is a rule that came out of the Dodd-Frank bill several years ago. Not many people paid much attention to it at the time, but it did require the Consumer Financial Protection Bureau to come out with, I think it was at that time, 8 questions to ask the customer because they were interested in what the customer base was looking at, making sure that the DEI, that all those things, women in business, minorities in business, that all was being taken care of. The current CFPB director, is Rohit Chopra, they expanded that question base from 8, I think it's 8, to, depending on who you listen to, 51 to 81 questions. If you go all the way down to if you answer no, I got to go to question number 2. And if you answer no to question number 2, I got to go to question number 3. And so it can be as high as between 51 to 81. We had a little argument over that last week in Washington. Questions. If you have to, as a community banker, deal with everybody that comes through your door and ask them those series of questions before you even talk to them about what business they're in, what they're there for, and how you can help them, who's going to do that? Number one. Number two, if you do that and then you get turned down for a loan, what's your first thought? Discrimination. So this is a trial lawyer's dream coming to fruition. However, just day before yesterday or Friday, the federal court in the Texas district saw fit to, and I'm not a lawyer, I'm grabbing for legal terms here. They enjoined the CFPB from implementing 1071 to banks in Texas and also members of the American Bankers Association, which they should have done. The American Bankers Association should have done that in a class action and should have done that across the board to all banks in the United States. So they are waiting for the Supreme Court to rule right now as to whether or not the Consumer Financial Protection Bureau is being constitutionally funded. If the Supreme Court rules that, who knows what the Supreme Court is going to do. But as of now, there is an injunction for enforcing 1071 on banks in that district and members of the ABA. I'm sure that there will be additional challenges to that quickly. If not from anybody else, you'll get it from Kentucky Bankers Association for all banks. More of a class action approach than anything else. If banks have to do that, they will go out of business. And let me say this, because this is probably the most important part, and I apologize for taking too much time. You have the right to not answer those questions. That's your constitutional right. However, the CFPB has said that if the bank has an abnormal number of customers who refuse to answer the question, then they will examine that bank because of the possibility of the bank asking the question in a wrong manner. Now imagine that.
And as Ballard said, I think what you'll see is you will see banks go
Yeah.
access to capital for small businesses be dried up because of that. And that's a very important thing that we're talking about and is a hot button issue for all of us in the banking industry currently.
bet.
Representative McPherson.
Yes, thank you, Chairman. So I'm a real estate appraiser by trade, and so what do you think, here's the $1 million question, what do you think the turnaround time between the time that people that have these long-term loans at low interest rate will sit in these houses, because normally 6 or 7 years they're going to turn something around, something's going to change in their life.
Right.
You know, it doesn't really matter. At some point in time, I don't care. I've got to refinance. I've got to move. I've got to do something. But what do you think the turnaround time is that we're going to have pressure on the market to keep interest rates low enough, and still at the same time try to bring those in balance?
Yeah, if 30-year mortgages are rarely outstanding for 30 years. A couple years ago, I asked for a list of loans we had that had been on the books more than 29 years. So who would be paying off a mortgage? I remember my grandparents being excited to burn the mortgage, and they did. We had one in the whole company that was in the next year so we sent them a gift and a congratulatory note and so forth. So they pay them off quicker, and you're seeing that today. I think you're seeing more houses coming to market because life happens. But when you have a rate of 3% on a mortgage, and you could afford nicer, and you'd like to have nicer, you'd like a little bit more space, and the new loan is 6%, you can't afford that payment. So only when life happens, divorce, death, move to a new town for a better job, is that all going to happen? Most banks, however, don't book 30-year mortgages. Most don't book 15. We book 5 and 7-year ARMs. So most of the loans at a bank will turn over in about 5 years. But 5 years is a very long time to worry about what deposit costs are going to do. If market interest rates are 5% and deposit rates that the bank are paying are rising, which they are, when do deposit costs get so close to 5% that there's not profit anymore, or not enough profit anymore? So they are going to turn over. They're not going to turn over fast, over about a 5-year period of time, but that's a long time to a banker.
Go ahead.
And we're still seeing this money from this employee retention money coming back in. That's just another influx of money flowing right back into the banks.
Absolutely. A lot of money.
A lot of money.
A lot, yes.
Mr. Chairman, Representative Pearson, I would like to add to what Dr. Hedgeback said. I spent an hour and 20 minutes on a Zoom call the other day with the Consumer Financial Protection Bureau with appraisers, about appraisers. It's an hour and 20 minutes I'll never get back. And it was a horror show. However, at the end of the entire Zoom was based on a case out in California, and at the end of the hour and 20 minutes, they indicated they'd like to take location out of the algorithm for appraising houses.
There's only three things about appraisers: it's location, location, and location.
Exactly. And I was watching on the side the chat board on the side, and the appraisers were, as you can imagine, they were apoplectic. But the CFPB thought it might be a good thing for them to get in and start looking at appraisers now, and the possibility of taking location, reducing the value of location inside that algorithm.
If I could just say that in rural America, that's just not going to work. In towns and cities, even in towns the size of Lexington, Louisville, or different, and Bowling Green, you can probably predict that pretty easy. But when you get outside of that, we get pressure all the time right now from having people send us data and us do appraisals sitting in our desk. And so I took 10 of these and decided I would look at them and see what percent and how good that data was. It was about 30%. They were missing properties, they were missing garages, they were missing property lines, they were missing everything. So I just sent them back and said, this is not an arena I'm going to play in until you all can get your data a lot closer to what I need, that when I go out and put my eyes on it, that I can be your eyes. Thank you, Mr. Chairman.
Representative Lewis.
Thank you, Mr. Chairman. And Dr. Hegemon, I appreciate your testimony in a former life, and this is before Dodd-Frank. I actually audited banks, and I know this is Bank Secrecy Act, SARS, all the fun stuff. But you mentioned several times in your overview that we need to proactively support rural banks. And so, of course, more regulations, tightening restrictions. I understand that, but to be proactive, I assume you mean passing policy. What would that look like?
That's a good question. And particularly at the state level, Ballard might be a better expert on that. Nationally, one of the things I asked Andy Barr to consider is the $10 billion limit for CFPB regulation and the $10 billion limit for debit card revenue. Debit card revenue is a big part of my revenues as a community bank. My customers use their debit card a lot. If you have a $1,000 checking account, I'm not making any money on the spread. Between what I'm paying you and the loan, you don't have enough dollars to matter. But the debit card revenue does matter. It makes it possible for me to bank you and provide you branch services and all the cost of clearing transactions. So I've suggested to him that number, which was set in 2010 at $10 billion, today on an inflated basis would be $17 billion, that maybe that ought to be higher to allow banks to continue to grow and not be hamstrung by that regulation. Because when a bank gets close to $10 billion, many of them will decide to sell and become part of JP Morgan Chase. And I don't think that makes the world a better place to have Wells Fargo and B of A and Chase be bigger organizations than they already are. So that would be one thing, but it's of course on a national level.
If you don't mind, I think tailoring regulations to size is very important. If you refer back to Dodd-Frank in your day of regulations, the majority of Dodd-Frank was not supposed to apply to any bank under $10 billion. It applies to just about every bank in the country today. Those things have a tendency to flow down. We have talked with regulator after regulator, gone to regional offices and so forth, and have been told that several times that you will rarely ever, if ever, see a banking regulation that doesn't apply to all banks. So the fear that we have at the Kentucky Bankers Association is that these limits are not held to. I think the states can tailor, can work in and tailor some of these regulations along with the Department of Financial Institutions to remain safe and sound rural community banks.
Yeah. Thank you. Thank you, Mr. Chairman.
Senator Howell.
Thank you, Mr. Chairman. I've got just a couple of questions. Dr. Hitchback, you had mentioned that you were seeing more ARMs, more 5- and 7-year ARMs. And are we seeing more of those in the housing market as people kind of mark time on a more adjustable rate loans and see what the long-term interest rates do? Have we seen more of that in the housing arena?
I think no. I think nationally most customers are going to opt for a 30-year mortgage. Banks tend not to hold those, and the number of ARMs is 1 out of 7 loans is an ARM. Homes over a certain price amount can't go into the secondary market and will end up on a bank balance sheet. So only a small portion of the loans that are made are ARMs, but those are the ones that my industry ends up holding. So those are the ones we know the best. And there's no, when interest rates are, the yield curve's inverted, so the 10-year rate's lower than the 7-year rate, which is lower than the 3-year rate. So there's an incentive for the customer to select the 30-year mortgage. Citi does a lot of ARMs by tailoring a product with no fees and a higher limit loan to value for customers that have excellent credit scores. So we're able to create we're able to get the kind of loans we need to fill up our balance sheet. But ARMs are not particularly. If the yield curve ever is steep again, so that the 30-year Treasury is higher than the 5-year Treasury, then you will see ARMs go up to maybe 25% of the originations.
Thank you. Another thing, you've talked about this a couple of different times. I've heard you mention it about technology challenges, especially for our smaller banks. Obviously, that's going to be in the cybersecurity type arena. And also something I hadn't really thought about as much until you mentioned it is the need to build out your online presence for this. Is there any other arena that creates some technology challenges, or are they pretty much limited to those two?
I would add fraud, which is a huge and rapidly growing problem. The crooks are ahead of us all the time in inventing new ways, and small banks don't have the systems in place to help look for that fraud. AI is likely to be implemented to help us sift through the data to be indicative of transactions that look like they might not be right. We've got a team of 5 people at Citi who look at transactions all day long, every day, and they catch over 100,000 bad checks a year. But they miss some, and they're continually getting tricked by new schemes that only a criminal mind could invent. So I think that's another area where technology is an advantage that small banks can't deal with. But the biggest one really is going to be the cell phone app, because that's what everybody wants to use. I wasn't a fan of that until our most recent release. And I said, I really ought to check this out. I looked at it and said, oh my God, this is super fantastic. I don't need to go to the branch much anymore. And if you don't have that kind of technology, it's going to be very hard to open checking accounts. If you can't open checking accounts, you're not going to survive very long.
Do the cell phone apps increase your fraud and security problems?
Not really.
One more question, Mr. Chairman, if I may. I do a lot of title work and am wiring money in and out, and I share in your concern and pain. I'm a nervous wreck sometimes when I'm trying to confirm wiring instructions and anything and all of that. Is there any discussion about moving to a different way of, or a different manner, or a different check and balance on wiring money to get away from some of the fraud issues? Is there anything out there that's being looked at or explored to try to end run some of the fraud efforts?
I haven't seen that, but I think there probably will be, because you read about the possibilities of artificial intelligence being able to replicate your voice and to be able to answer that phone call that comes back and you and wire money out of your account.
Yeah, we do confirmations on all that, and we have to, if we have to go to the level of confirming who we're confirming with, it's going to bring an interesting set of challenges.
I think the Fed Now program is probably going to help a little bit in that arena.
What is that?
The Fed Now program. It's where the Fed gives you immediate access to your funds.
Okay.
It's just now rolled out.
Great.
So it'll take a while to get everybody acclimated to it.
Maybe a long while.
A long while, yes.
Thank you. And Ballard, I am glad to see that it was a tough lesson for you, but you finally learned to accept advice of counsel more willingly, and I hope that your arm heals up pretty quickly.
I learned to pay John's bill on time as well.
Right.
So.
Final question for the panel, Representative Smith.
Thank you, Mr. Chairman. I'll be real quick and brief. In listening to your testimony, I think when you first started out, you was looking for ways of community banks being have more ability to get in, able to get money out. I understand the money that was brought in. A lot of it was in my area through the injection of the programs, and that happens. It's not stopping. We're seeing still more federal dollars being brought down, pumped into our communities. In saying that, I wanted to kind of make a statement for you to look into, mostly the Kentucky Banking Association. We have strong community banks in my area with 4 banks and several of them that participate a lot in our community. But there's something that we passed several years ago called P3 that it really hasn't taken a lot of legs. And I think the banking industry could really benefit from that in community projects rather than federal dollars or state dollars coming in and doing a large project. You could see participation with the banks. And I would look more into the P3 market because there's going to be more and more infrastructure dollars coming through the Infrastructure Act. I think it was $1 trillion something dollars. You're going to see a lot of those dollars come through Kentucky. And a lot of those are going to be benefiting local communities. And if I was a local bank, I would try to figure out a way to participate, because you look at small business loans, SBA loans as a 80% guarantee. You may find it attractive to participate in that to find ways of deriving some income. But I just wanted to throw that out. That is coming, and it's going to be here for probably, with that much money, 6 to 10 years of infrastructure. And I would volunteer in the communities to look at P3s. I'm not saying I know a lot about P3. I just know it gave access for state and private, or really local governments and privates to come together on projects. So anyway, I wanted to throw that out, Mr. Chairman.
And Representative Smith, I'd just say, and we have had some interaction with that in the space that I work in. Sometimes it's, it may be a fire department or a water district or whatever that comes to us. One of the things, and I think Skip led to this in some of the discussions he was having, that makes it hard is when the government rate on those loans is at much below market, it makes it very hard for us to compete. And we want to do what's best for that consumer that's in our office that may have a deposit account with us or whatever. And many times it is that they have to come to see us to find out that they can't get a loan at the rate that they can get from the government. We have to provide them that letter so that they can then qualify for that government loan program that's out there through CDBG or whoever it may be. And I've been in that situation several times. We've got to move on to the next presentation. Thank you, gentlemen, for being here and for answering all the questions. Commissioner, would you like to introduce our next guest by Zoom, or do you want him to just do it from the program?
Thank you much.
Okay. Jim, if you would introduce yourself for the record and then proceed with your remarks, we'd appreciate it very much.
Oh, great. Thank you, Mr. Chairman and members of the committee. Also, Commissioner Burse and Ballard, although I can't see you. Nice to hear you as well. So my name is Jim Fuchs. I'm with the Federal Reserve Bank of St. Louis. For those of you who may be unfamiliar with the Federal Reserve districts, I know a lot are not, but the Western Kentucky is in the 8th district, so that is the St. Louis Fed. One way to think about it is Frankfort is in the 8th district, but Lexington is not. That is in the Cleveland Fed's district. There's a whole history of how we picked those lines back in 1913. I suspect that if we did them again this year, they would be slightly different, but nonetheless, we've had more than a 100-year history with the western part of Kentucky in our district, and I'm pleased to speak with everyone today. I believe everyone has a copy of my presentation, so I will. I'm going to share that now. Please let me know if you can not see it, Mr. Chairman or members of the committee. It should be on my screen, and I know you have hard copies in front of you.
We can see it.
Okay, great. Again, pretty generic title: Economic and Banking Conditions Update for Kentucky, and certainly Dr. Hedgeback. Appreciate your remarks as well. I will note a couple areas that I have responsibility for here in St. Louis. I am in bank supervision, so I have responsibility for our mergers and acquisitions unit, or bank applications as we call them. So we get to see a lot of that transaction activity that was referenced in the earlier presentation. Also lead a risk team, so we are looking at risks to the banking system. Also have responsibility for the discount window, so that is kind of providing liquidity in times of distress or just in times of need to the banking system. The PPP program, while that came through the SBA, was backed by the Federal Reserve through a program called the PPP-LF, the Paycheck Protection Program Liquidity Facility. And we are currently, since March, operating the Bank Term Funding Program. That is a program that values a number of those securities that Dr. Hedgeback mentioned, values them at par instead of market value. Which enables us to, that serves as the collateral, and that enables us to provide liquidity in larger amounts than we otherwise would have at market value securities. And that program, which I'll discuss very briefly, is scheduled to conclude in March of 2024. So let me just go through just very quickly, and I know my time is limited, so I'm glad everybody has a copy of the presentation. I may skip through and just get to some of the highlights. I do have to note that the views expressed today are mine. They do not reflect the views of the Federal Reserve Bank of St. Louis, the Federal Reserve Board of Governors, the Federal Reserve System, or the Federal Open Market Committee. As I'm sure you're aware, we had our meeting last week, and the Federal Reserve resumed its increasing interest rate policy. I'd also like to thank economist Kathleen Navin, who is my colleague here in St. Louis, for her assistance with this presentation today. So let's very quickly look at some economic conditions. In blue, we have just real GDP. Red looks for the state of Kentucky. That, at first glance, that doesn't look particularly promising as we look at GDP growth in 2021. However, if you look at that, especially for the national GDP in blue, if you look at that 2.1% reading, that is more in line with some of the growth that we've seen in the past decade. So if I was going to title my presentation in a more interesting way today, I would say cause for optimism or cause for concern. And I think we're seeing evidence of both. And I think even in the last presentation, we've heard some examples of concern and also on some level some cause for optimism. As we look ahead, we are seeing stronger growth in 2023. So the most recent reading of 2.4% came in a little bit higher than expected, which again, when we're looking at a interest rate environment that is currently increasing, we have a situation where a rising GDP certainly seems to push against that a little bit, right? So it speaks to still some very strong fundamentals in our economy. We talked about housing, and housing is one of those areas where we very quickly see the impact of interest rate policy. The discussion earlier on 30-year fixed rate mortgages, you can see a picture here of overall we can let me look at the transactions price index, because I think that's where we have kind of a more dramatic situation, right? So right now we have mortgage rates in the high 6%, which was mentioned before. That's nationally. These data, especially on the right, come from the Federal Housing Finance Agency, which is they estimate they're looking at an overall index based on repeated valuations of the same property over time. Now, they only look at properties with mortgages purchased or securitized by Fannie Mae and Freddie Mac, but you can see again how overall, we are seeing some improvement in affordability, but as the price index goes down, but certainly challenges remain in housing, particularly as we look at those higher interest rates. As mentioned before, a lot of those mortgages are locked in at much lower rates. The incentive for refinancing, of course, is zero. There are natural events that would cause turnover in property, but we're also hearing a lot more reports of cash buyers as well, or folks that are just downsizing. This gives you a little more picture of Kentucky. So again, a little bit of cause for, I guess it depends on where you sit, right? So, if you're looking to sell, that strong house price appreciation on the left is certainly very favorable. But kind of in aggregate, we are still seeing significant increases overall, but they are less when we look at 2023, the first quarter. And again, this comes from the Federal Housing Finance Agency, so they don't necessarily have enough transactions in every market in the United States. So it's where they have concentrated transactions that we see some of the data. Moving to slide 8, again, when we look at home sales, this is really, supply and demand is incredibly important, and we can see total home sales declining And also, I think on the right chart, total existing homes available. So, supply is down. There is a challenge in getting new inventory on the market, and we're also seeing a little bit of a shift in where consumer interest is, more of a shift away from multifamily and back into single family homes. And that's what these pictures on slide 9 show. I think the most interesting piece here, though, is on the left we have housing starts, single family unit on the blue line, multifamily in red. It looks as though we are seeing kind of an increase, particularly for single family units. And we see that same story on permitting. So this gives us a measure of future construction. Blue line on the right side, we see an increase. But when it comes to multifamily, we're starting to see some softening and looking ahead in terms of permits issued for multifamily units. Moving on to slide 10, for those of you that are following along, we continue to see strength in consumer spending. Now, in this case, it's led by goods, right? So when we look at overall real PCE, the personal consumption expenditures, the one-year change was 3% in June. So that's headline inflation. You hear us at the Fed talk a lot about headline and core. Core just strips out energy and food. It's just another way of thinking about inflation. It's because traditionally, food and energy are much more volatile than other goods and services. And so the next release for real PCE will be on August 31st. So this captures kind of our current thinking. Now, again, the line should always be going up with, we do look at, the Fed has a 2% target. So kind of a general increase makes sense. Just by way of comparison, just to see some of the evidence, the one-year change from the last reading, as I mentioned, was 3%. Again, that's headline inflation. That's down from 3.8% in May. So again, still a positive trend. That's expected, but not quite as steep. It's starting to level off a little bit, which again shows some of the effects of the Federal Reserve's interest rate policy. Real income is softened a bit following the pandemic surge. But what we're seeing now, particularly if you look at that right graph, right? So this is revolving consumer credit owned and securitized. We're seeing a significant spike. Overall, consumer credit increased 1.8%, revolving credit increased 8.2%. So that's your credit cards. So we're starting to see people utilize those lines again. This may be a little bit more of a sign of some of those excess funds that were in the banking system being drawn down. And non-revolving credit actually decreased by 0.4%. And that includes, car loans, mobile home loans, education loans, boats, trailers, vacations. So there's a lot in that non-revolving. So again, we're seeing a little bit of the impact of interest rate policy. But even when we look at some of those non-revolving loans, the rates are pretty high. Average car loan rate from the last Fed report was 7.81%, and that's for June. In May, up from 7.48% in the first quarter. Again, that's average across the country. So again, the cost of credit is very expensive to a lot of consumers, keeping a lot of individuals on the sideline. And again, what we're seeing is there is a difference between what we're seeing in core and headline inflation, where where goods prices seem to be moderating a bit, but services not as much. And that's where we see this. This is a fairly interesting chart, because typically that headline inflation, right, is as you can see in January of 2022, it's generally going to be higher than core. Right? Because we've stripped out, we've stripped out, food and inflation. But right now, core inflation is 4.1, headline inflation is 3.0. And again, that's because we're seeing the difference between inflation in goods and services. And this gives you just a little bit more, a little bit better picture on what that looks like. Part of the reason for this is that we have seen a little bit of easing on the right side of this of global supply chain pressures. We are still in a situation, as I'm sure many of you who have gone out to eat or been involved in other service type activities. I'll tell you, I just got back from a trip to Alaska, and a number of places were closed or with limited hours. It's hard to attract folks to certain parts of rural Alaska for jobs, but at the same time, the impact is very real, and so we still see job openings outpacing the overall labor force that is currently looking for jobs. We are seeing so that is a very tight labor market. We are seeing some signs of softening. The unemployment rate is very much holding steady here in the state of Kentucky. Again, more or less nationally as well, but it's up a little bit from where it was, but again, not much. So this is part of that conundrum that the Fed is facing with its current interest rate policy. And when we look overall at employment, Kentucky actually is one of those states that seems to defy some of the trends. So this is that dotted line just marks the 2020 level. So employment in Kentucky has exceeded the level for 2020. Sorry, my slide seems to have gotten stuck here. There we go. Just to give you a bit of a picture of where that strength in employment comes from. On slide 17. So employment is exceeding pre-pandemic levels in education, and this is in Kentucky, in education and health services, professional and business services, trade, transportation, utilities, and manufacturing. Again, not surprisingly, still weak in leisure and hospitality. And also, interestingly, government employment has not returned to its levels immediately preceding the pandemic. Job openings, which are which are a sign of our of kind of our labor market. They have turned down, but again remain elevated compared to where they have been historically. So again, this is still there's still a lot of jobs that need to be filled, both in Kentucky and across the United States. These data are indexed. So basically, we started before the pandemic. We set both the levels of Kentucky and the U.S. at 100, and then we see how they've changed. So this graph really marks a change over a fixed period for both job postings in the United States and the state of Kentucky. As we know, labor force participation is important to understanding kind of labor markets and our economy. Kentucky typically has a lower labor force participation rate than the rest of the country. But we are still, from a participation rate standpoint, we see both in Kentucky and nationally, a lot of folks are still sitting on the sidelines. There are also some demographic factors at play here as well. Taking a quick look at financial conditions. So the St. Louis Fed publishes a financial stress index where zero basically means above zero. We are seeing above average stress in financial markets, and below that line, we are seeing below average stress. So again, a little bit of a conundrum here, right? Financial markets continue to be strong. We can see on the right side, when we just look at the S&P Dow Jones, we're not quite at where the S&P 500 was in the middle of 2022, but it is starting to increase and get to those levels. So, as I said before, cause for concern, a cause for optimism. There are signs of both. Here's where I will just say we still have an inverted yield curve, right? So if you look at the 10 and 2-year spread, right, we are at negative 0.91. The inversion of the yield curve. So you can see, if we look at the brief recession here in 2020, right? When it When we basically have market yields on shorter term securities going higher than longer term securities, it's usually a predictor of a recession. If I took this back further to 2008, 2009, you would see much more predictive basis. And so this is normally considered a very reliable indicator of a recession. The spread is usually a positive 0.89%, obviously with 10-year 10-year yields much higher than 2 years. So again, we're seeing those signs of a pending recession, but there are other signs in financial markets and in consumer credit and labor markets that push against that story as well. And then I know we talked about some banking conditions earlier. I know the state of Kentucky, thanks to Commissioner Burris, is very much involved with the Conference of State Bank Supervisors in producing this Community Bank Sentiment Index. As we heard in the last presentation, community bankers in particular are not optimistic. This is the lowest reading since this index was created in 2019. And the past 3 times that the index, it's a quarterly index, was published. These are the times we've seen. It's the 3 lowest readings the last 3 times that we've seen them. So again, community bankers are not particularly optimistic about what is going on in the economy. They are predicting a recession, some of the narrative around this survey. So just to see some of that, right? We are seeing an increase in the delinquency rate and charge-off rate for consumer loans in particular. Those are some of the more small dollar loans. If we look at business loans, the charge-off rate, we're starting to see a slight uptick, although the delinquency rate is at least trending in the right direction. Sorry, it looks like I had another issue there in my slide advancement. When we look at real estate and agriculture, however, charge-offs in real estate and agriculture remain low through 2023 in the first quarter. A significant drop in delinquency rates on ag production here on the right. We are seeing a slight increase in charge-off rates for ag, but it's off a very, very low and historically low base. And same when we look at real estate secured loans at commercial banks, delinquency rates and charge-offs. First off, delinquency rates are within historical averages, and as are charge-off rates as well. For consumer and C&I loans, so this comes out of the senior loan officer survey. We are seeing tightening credit standards. So again, this is that cause for concern or cause for optimism. This may be a little bit more for concern as we see tightening standards, and it makes sense in a rising rate environment for credit cards, auto loans, consumer loans, and then if you look at C&I loans as well. So we're seeing an increase in overall standards tightening. And then when we look at commercial real estate, which has received a lot of attention lately, again, we are seeing an increase. We are seeing tightening standards. So again, anything above the 0 line, we are looking at tightening standards, and then we have loosening standards if you're below that 0 line. The earlier presentation talked about the surge in deposits. This gives you a graphic representation of that surge. So the red line is deposits and the blue line is loans and leases at all commercial bank. We see lending is kind of slowing, is moderating here, and that surge in deposit is unwinding and looks like it's starting to stabilize a little bit. And that's what this picture shows as well. If we look at the deposits at all commercial banks, this is total number of deposits in the system. We do see a little bit of a stabilization after recent outflows. Some of the conversations we've had with community bankers that indicate that despite some of the challenges that we saw in March and April, and a lot of community bankers did not personally experience that deposit flight. And I think it speaks to many of the things that we heard earlier. The amount of uninsured deposits in the community banking system are significantly less than we've seen in some of our larger and regional banks. And again, here this gives you more of a representation of how deposits flowed more specifically, right? So if we look at deposit flow here in 2023, you can see the decline in deposits. That blue bar is large domestically chartered banks. Even that has started to recover a little bit. The hit is much less for smaller banks. We are monitoring lending for signs of credit tightening. Again, at this point, though, loans and leases at all commercial banks seem to be fairly stable. Again, that surge that we're seeing throughout 2021 and 22, that is a lot of that from the pandemic and kind of coming out of the pandemic and post-pandemic lending as well. And this gives you a graphic representation on the right of loans and leases, and broken down a little bit more by large, small, and then foreign-related institutions. We are seeing banks continue to use that bank term funding program. You'll note here that the primary credit is your traditional discount window lending program. As of today, the primary credit rate is 5.5%. So that's what the Federal Reserve lends to banks. It used to be on an overnight basis. The Federal Reserve switched to a 90-day term during the pandemic, and it has not, for primary credit, and has not relaxed that. The Bank Term Funding Program, as of this morning, it's a daily rate is at 4.47%, and then for banks that keep balances in their master account, the rate we pay on those balances is 5.40. For our ag banks, the Fed does have a seasonal credit program, and the current rate is 5.25%. But again, this program, we're about midway through, and we expect to it is expected to end March 11th, 2024. And just a few pieces about the Bank Term Funding Program. As I noted before, collateral is valued at par instead of the market rate. So again, that's designed to allow the Fed to lend more on collateral that may have taken a hit as a result of the inversion in rates. These are 1-year advances, no prepayment penalty, generally a favorable rate. There are still concerns, and this is an area that we just don't understand. The Fed's emergency lending programs and also its standard liquidity programs have been there and have been in existence for a very long time, but there is still stigma associated with these. Dodd-Frank required that all primary credit loan and seasonal credit loans be disclosed to the public by name of the bank after 8 quarters. And the disclosures will begin in 2025 for the Bank Term Funding Program. The view of regulators, the FDIC, OCC, the states, and the Fed are that the Bank Term Funding Program and primary credit is part of a sound liquidity management program. But again, there has been some hesitation in terms of overall usage. And then just very quickly, and I'm looking at the time, there probably are a number of other topics. In fact, the discussion earlier touched on a number of things that we look at here at the St. Louis Fed, and we're particularly interested in. I thought we put together just a quick slide on buy now, pay later, because we've seen it grow in popularity. In general, again, these are my views. We don't necessarily view this as a benefit to consumers. There are other options out there. Community banks offer a number of options, but this speaks to convenience. We talked in the last conversation about the convenience of technology, the importance of technology being there in the moment. But what we are seeing is that in general, this is a product that, while it has a lot of gets a lot of attention right now, it is still attracting folks with high amounts of credit card debt who use pawn shops and payday loans and have experienced overdrafts. So these are programs that they may provide some benefit in real time, but right now they seem to be utilized by some of the same folks that have struggled in the past with managing their credit. So again, I wanted to include this. There's lots of other topics we can talk about. We also have a center here in St. Louis for the study of competition and competitive factors. That is that's becoming more and more interesting as banks are exploring different merger combinations. It is the current formula used by the Department of Justice looks at physical geography of one's branch network. when it determines if a merger is going to create competitive concerns and whether it could be allowed or not, it does not currently account for the phone. It does not account for the fact that banks can project their brand into any corner of the United States and compete. And I think to some of the points that were raised earlier, when there was some initial deposit outflow, there were also a number of non-brick and mortar, online-only banks that were able to offer very competitive rates and launched aggressive marketing campaigns to try to attract those deposits. So it is a brand new ecosystem in many ways, and a lot of times our laws don't necessarily keep up with the growth in technology. Again, as mentioned in the previous presentation, the growth in technology tends to outpace a lot of industry in this country. Unfortunately, as was mentioned, that also applies to fraud and cybersecurity issues as well. One final point I'll make, and then I'll close. We are fortunate here in St. Louis to host an annual community bank research conference. This will be our 11th year of doing it. Ballard, I know you're very familiar with it. So we made a commitment to attract academic research on community banking because we believe it's important to understand relationship lending and the value that relationship lenders provide to the United States economy and to local economies by analogy. Our partners are the FDIC and the Conference of State Bank Supervisors, who also does an annual survey looking at a lot of the threats, challenges, and opportunities facing community banks. And we continue to see a significant increase in concern over regulatory costs, which was mentioned earlier, cyber threats, and fraud. So that survey was wrapped up, and I know Commissioner Burris was very involved with that with Kentucky banks. The survey period closed in July, and the results will be released in early August, and we look forward to being able to share those. So with that, I'm going to stop. I'm going to stop sharing my screen and appreciate any questions anyone might have, and appreciate certainly the opportunity today to share some pictures and ideas with you, Mr. Chairman, and members of this committee and other distinguished guests. So thank you.
Jim, in the interest of time, I think we're going to move on beyond questions and catch our other presentations, but do appreciate the information about the liquidity program, which I think is vital right now in the environment that we find ourselves in. And also, I think it is a little bit of a positive to look at some of those graphs where we see that that delinquencies and things of that nature, charge-offs, are much lower than what we saw during the recessions in 2008 through 2010. And I think that's good news for the industry, even though they are up currently to some degree. So thank you very much for being on with us today. At this time, I'd like to call Edna Hughes up with Bluegrass Bankers Association. I've known Edna for several years, and I think Edna would be representative of what many of you all from small rural areas in this committee would see back in your communities, a locally owned bank that has 3 to 4 branches or maybe less, maybe a few more, and she's going to talk just a little bit about that smaller bank perspective on some of these things as she's before us today. So thank you. If you would just introduce yourself for the record, Edna, who you're with, and then proceed.
Okay. Good morning to you all. My name is Edna Hughes.
Get your mic, Edna. Press the button. It should turn green.
I got it now. I'm usually pretty loud anyway, but good morning to all of you. I'm Edna Hughes. I'm representing the Bluegrass Community Bankers Association here in Kentucky. I'm president and CEO of Lewisburg Banking Company, and we're located in Logan County. Next February in 2024, we will turn 130 years old, and we have operated under that same charter since February of 1894. And that's something we're very proud of, because I do feel like, and there are still several really old banks in Kentucky, but the numbers are decreasing all the time. And we've had such wonderful presentations ahead of me. I'm a little bit nervous because I'm like, okay, there's a lot of the things that I wanted to talk about, and they've already discussed it probably better than I could. But what they shared with you is all very true. I couldn't hardly add anything else to it, except for the fact that I do it every day. And I guess another thing is that, what is the definition of a community bank? My bank is around 180 million. That's quite a bit smaller than a $1 billion bank, a $5 billion bank. depending on what you look at, what regs you're reading, depends on what someone determines is a community bank. So the Bluegrass Bankers, we have 51 members strong, and most of our banks are under $1 billion. And things are very different when you're as small as we are, and a lot of my other banks. I've been banking for 41 years, and I've worked in 2 community banks during that time. And when I started as a teller, we didn't have any computers. We did everything by hand. Some of you are not old enough to remember, but banks always closed at 2 in the afternoon, and that's because we had to do everything by hand. We didn't go home till 5 or 5:30. Everything was handwritten. So a lot of things have gotten better on that perspective, but then again, they've gotten so much more complicated. Also remember very well that we had 3 to 5 policies that we had to maintain. You know, a loan policy, your asset liability, you know, your human resources, just some really basic things. And things to a point were pretty easy to run. So today, you spin forward, and even a small bank like myself, we've got around 75 policies. That doesn't include all the procedures that go with those policies that are referred to, that everyone has to be familiar with. So many things that we've got to be aware of to be able to operate and to serve our customers, but also to satisfy our regulators. Like all banks, of course, we're regulated we're a state charter bank, so we are regulated by the state of Kentucky in the Kentucky Department of Financial Institutions. And then all banks have a federal regulator, and our federal regulator is the Federal Reserve Bank of St. Louis. I think both of those agencies do a wonderful job. Kentucky as a whole has always been a conservative state, and I think our banks are conservative, and I think that that has really played a big role in the fact that there's been very few bank failures in Kentucky over the years. But we also must give credit to our state and federal regulators, I believe, and especially our state regulators, because they know us better than anyone else. And the KDFI has done a great job, as you well know, I'm sure. But, and I don't want to step on any toes with this, but I really feel like, and I don't know how all that works, I'm just a small community banker, I feel like they need some more money. I think they're short-staffed. I think that they can't help that. And I know the number of banks that they are regulating has shrunk over the years. But if we want to maintain those good, safe banks, I think they need a boost. I think they probably need a little boost with their technology efforts. That takes money as well. And I feel like that they're going to have to get back into some realm of technology oversight, which I think has already started. But again, that takes money. It takes expertise. We have actually had some federal or state regulators in the bank that we used to see the same people. For 20 years, we would see the same group of people, and now we don't see the same people every time when they come every 3 years. And we might ask, well, where is so-and-so now? Well, they're making more money. They went to the Federal Reserve. They went to the FDIC. They were hired away from a bank, by a bank. So, I feel like that we need to boost and help them to boost their agency by, whatever that takes to maintain that experience. Because you know how frustrating it is in your own jobs. I know it is with me when you get somebody completely trained after 1, 2, 3 years, and then all of a sudden someone that's got a deeper pocket than you do hires them away, and you have to start all over. That's not good for your institution, your business, and I'm certain it's not good for the KDFI. So I'm a big cheerleader for them. They're our friends. regulation, I think regulators and the way that they operate with banks has changed much over the years. I can remember, and maybe it was because I was so young and so green, but I can remember they would come unannounced years ago, and they would show up at your back door just as you were getting ready to close, usually at 2:00. There'd be that tap on the door, and they would come in, and it looked like crime scene tape, and they would tape all your drawers down. And because, again, we didn't have computers, so they didn't want you to get in the drawers, and then they would go count the vault cash. And we were very intimidated by them. They came in the black state cars, and they had on suits. And things are so much different now, and I'm so glad, because I really do feel like that, even the federal regulators and the state, they're our friends. We worked shoulder to shoulder. We're after the same common goal, and we know what it's going to take to keep strength in our community banks and to maintain this level. And I'd like to really thank Chairman Meredith for his excellent leadership in this committee and just, in general throughout the state. He has a great awareness and brings a lot of leadership and expertise to this committee, I believe, because of his strong background in a community bank and in banking. And I know he's reached out to the KBA, the Bluegrass Bankers, the KDFI over, the last several months to be able to get us to start thinking about things and to join together to, again, strengthen this, business that is so important to every aspect of our state or of our Commonwealth. And I guess in saying more about community banking, and I think most of you know that, we are the backbone. When we're these small community banks that aren't, we're concentrated in a certain area. I'm all in one county, in Logan County, but we're the financial supporters for the schools, for sports teams, maybe a beauty pageant, the nonprofits. They come to the banks and they expect for us to help them, not only monetarily, which is very important, but guess what? All of us and our employees are out working at those county fairs and the 4-H steer show, helping to make everything happen. And we know our customer base very well. I've told my employees for a very long time, even long before I became president, that there's big banks everywhere. They're on every corner, and now they're all over your phone, and any way you want to be in contact with a bank, you can make that happen. And the only thing that we have to offer in the community bank that is really different is those personal relationships. And I think that's a big discussion in the fact that when times do get tough, and we've been through some of those, obviously, as all banks have, we normally can get on top of those things before they really happen, because that's how well we know our customer base. And I know that's not possible in every bank, but it's really important in a lot of our rural counties, possibly underserved counties. We talk about, a while ago with the Federal Reserve, he was talking about the different kinds of loans. The loans that people have to get with pawn shops and pay-as-you-go loans and things like that. And we see a lot of that, and we're never going to eliminate all of that ever in the community banks. But people will come into the bank, and they will not have a good credit score. And we try very hard to coach them, because sometimes we can actually get some good collateral. Maybe mom and dad will co-sign. There'll be different things that we can do to try to help them. But it's not just a flat no, like with maybe a centralized lending product. We know those people, and we try to lay out a plan, if they'll stick with us, to be able to help them get credit. So I've always thought, it's kind of like the food that's the worst for you is maybe at your Save-A-Lot, and it's really cheap. It's, you know, fatty things, and you can just pick up a box of cookies for $2 and macaroni over here. But if you go to really get good food at Kroger or someplace equivalent, it's expensive. And it's kind of the same way with credit. Like if you're not worthy, then you're going to have to pay a whole lot more. You've got to shop at a place where you're paying 24, 30%. And there's just a fine line there. And I think a lot of times that we can help people in the community banks. And, you know, we talk about the unbanked. I think the last statistic I saw was in 2021, there's 4.5% of the population that's unbanked. Let some of these community banks go by the wayside and be bought up by the bigger banks. And I think we're going to see a whole lot more than that. And we're going to see a spread between that low class, upper class, that, you know, as we see that squeeze. And then the small business lending, something that we do very well. And the ICBA reported last year 60% of the small business loans in the nation is made by community banks. And again, it's one of those things. And we talk about, you know, what is a small loan? $25,000? That happens every day. Maybe 15. Maybe we just need this little piece of equipment over here to help us better automate something. We don't typically see on a regular basis $500,000, $750,000 loans. A lot of the loans that we do that are small business are under $100,000. And it's not worth a lot of people's time to fool with those. But that is the backbone of our community. And they employ people, our small businesses, that in turn bank with us. And you know, I don't have to explain to you what that trickle-down effect is. Community banks are leaving at a rapid rate. And I think that's something that's fully aware by everyone as well. And there's a lot of things that factor into that. One is the uneven lending playing field. And I'm not going to dwell on that very often, or very much more in this presentation, but what I will say is this. You're probably aware that there are some institutions that are operating that are lending money that don't have to pay interest or pay taxes on the interest that they're paid on those loans. And I'm speaking of credit unions and farm credit. And that's all I'm going to say, because that's a different topic for a different day. But if I could make all my loans and not pay any taxes on that, that would be a game changer. But guess who else it would be a game changer for? Be a game changer for all of our local governments and the state government when you didn't get our money for those taxes. So I think those are some of the things that we need to think about as well. Fintechs playing a big role in the way banks are operating. The expense as a whole lot of our expense that I can just really tag back to when Dodd-Frank was introduced, because that kind of started a roller coaster. We were forced to invest in new software, technology, compliance, personnel. We just have a lot of high fixed costs that are disproportionate to larger institutions. And that's just pretty well the tip of the iceberg. It's really funny because in 1982, I was at Western Kentucky University, and I wasn't going to even be a banker. I came from a banker family. I didn't like it. They were the most boring people I've ever seen in my life. And I was going to be a journalist and live in New York City with a cat. Well, I'm really glad that all didn't happen, because can't imagine that there'd be any job I would have that would be more fulfilling. I just love my customers so much, and the people that I work for, and the people that have helped me be president of a bank now. But when I did take a banking class, my dad insisted on that, even though I was going to be this journalist. And that professor, he said a couple of things that have always stuck with me. And the two things that I'll share with you is that in 1982, he told us by 2020 there would be no checks. he's not going to miss it by far. He said by 2030, there will be less than 15 banks in the United States of America. Don't let that happen. And so I don't have all the answers, but I just appreciate you allowing me to share with you that there is a place for us. We're the mainstay in our communities, but the trends are not in our favor always. No matter how much we all love to talk about local and shopping local and the idea of local and small, we aren't winning right now. When community banks die, an entire sector of people and businesses will suffer, and that's for sure. We're mostly locally owned. I have 50 shareholders. They all have ties back to Logan County. All of my board of directors is from Logan County. They just know what makes our area tick, and it's the same way and the same story at all the community banks in your communities as well. The sins of big banks have not really crushed our spirit, but it's definitely crushed our pocketbooks over the years, because we get punished every time that anything big happens, 2008, whatever. And I'm sure there will be other things to come down. But we have sustained. We have quite a bit of spirit about us. So I would just ask, as you move through this committee and your fine leadership for the Commonwealth of Kentucky, that you keep an open ear to the things that will help our banks, and especially our small banks, sustain for years to come. And I really appreciate your time.
Thank you, and I appreciate you being here. Again, in the interest of time, I'm going to move on to our final presentation of the day. If our folks with the creation of the All-Player Claims Database could come forward, introduce themselves for the record, and then you can proceed with your presentation.
Well, I guess I got to stand up behind you so I can say it loud. Yes. Introduce yourself.
Intros? Yeah.
Good morning. Good morning, Mr. Chairman. My name is Dr. John Langfeld. I'm with principal with Insights for Health.
Good morning. Thank you very much for having us. My name is Jenny Goins. I'm the president and CEO of the Kentuckiana Health Collaborative.
Good morning. My name is Jeff Talbert. I'm a professor at the University of Kentucky, but I'm here talking as a health services researcher here today.
Abigail Gold, Department of Insurance.
Well, Mr. Chairman, thank you and the committee members very much for the opportunity today. And we're here today to really highlight the imperative for establishing an all-payer claims database in the state of Kentucky. And if we think about what the vision of that is that the all-payer claims database is to improve the overall health of Kentucky's children, family, communities, and workplace. And in pursuit of that, we've spent a lot of energy over a number of years in this concept of value. And of course, at its basic, value is this delicate balance between optimizing quality against cost, obviously, that can be very helpful. We have a wonderful resource in Kentucky called the Kentucky Health Information Exchange, or KHI. And KHI is a wonderful resource because it's a conduit for transmitting information from between providers. So that's another resource. We have the registries. We have the immunization registry. We have the cancer registry. And we have a whole number of what we call Internet of Things, where increasingly there's all kinds of devices that are submitting information that we have access to. So as we build this foundation of a database that gives us a comprehensive look, we begin to think about where are the gaps and where are some of these other parts of data that we can really start to pull together and create a much more complete and holistic picture
of what's occurring and actually create what we call a single source of truth. And so as we think about moving forward, let's create that single source of truth. There's a couple things. There's lots of goals with our all payer claims databases. You're going to hear about some of those in just a minute. And as far as uses and users, it's a growing list, and that's really determined by the committee that helps control the database itself. So with that, I'm going to have Ms. Goins talk about the employer perspective.
Thank you, Dr. Langfeld. And just to give some credibility to coming to you from that employer perspective, the Kentuckiana Health Collaborative is an employer-led, multi-stakeholder coalition out of Louisville, Kentucky. But our mission is to build healthier communities through high-quality, affordable, and equitable health care in Louisville, throughout Kentucky, and southern Indiana. We have been around for 20-plus years. So I wanted to share that. Also, I have been in the employee benefits space for about 15 years, and I led the Kentucky Employees Health Plan as deputy commissioner and then commissioner for a combination of about 10 years and 3 governors. So I feel like I come to this having been in the seat of the employers, but also leading employers. And one of the first things that you'll see is improving the health of employees while controlling cost is something an APCD can help us do. Dr. Langfeld mentioned all of the different data sets that we have available in Kentucky. Even the Kentuckiana Health Collaborative has a data measurement program where we look at HEDIS measures and we release those HEDIS measures and we look at communities. But all of these pockets, as you'll see in the last bullet, does not put everything together in one concise place that we can really look at high quality, affordable, and equitable care. In that second bullet, you're probably aware that in the last year, the federal government has come in and put a layer on employers. I mean, I can say from running a state health plan, fiduciary responsibility was always important, along with good benefits for employees who are all of our communities and our constituents. We always looked at fiduciary responsibility, but now the federal government is saying you have to pay and are responsible for paying for a fair price. How do you know if you're paying a fair price if you don't understand the data in the communities and across the state? And then that all boils down into that benefit design and planning. And on the next slide, Dr. Langfeld mentioned that we are 43rd in the nation. So the state graph on our nation graph on the right is highlighting communities or states where the ranking. So the lighter the color, the better. Kentucky is in that dark blue. When I go around, and I have had the opportunity to go around the country to talk about healthcare benefits, I always joke that Louisiana and Mississippi, I thank goodness for them because they're lower than us. We're not going in the right direction. We're staying as low as those other southern states. If you look to the left, that is a map of states with APCDs. 10 of the highest ranked healthy states have an APCD. So I think that correlation is important, that you're able to really look at healthcare from a larger lens when you have all the data in one place. The next slide, this is a concern for employers. When we recognize for the last few years, Medicaid and Medicare is spending at a particular rate, but look at where commercial plans are paying. That private insurance is moving and increasing at a rate faster than Medicare and Medicaid. And if we can go to the next slide, Dr. Langfeld, thank you. This is what's worrying your constituents, your communities of people, is that commercial private pay, they have skin in the game too. So you can see 73% is, well, my glasses are not helping me with that big screen. I'm gonna have to look at my little slide here. So that 73% is overall inflation. Workers' earning is increasing at 101%. That worker contribution at the very top in the light yellow is 290% for a family premium. We can't sustain that as employers or as communities for your constituents. We have to do better, and being able to understand all of the components of the healthcare system is extremely important to employers to be able to understand what's happening in healthcare to make sure we have quality, high quality, affordable, and equitable healthcare. And the last slide is just showing where we are in Kentucky compared to our some states around us when it comes to the total annual premium for family members. And so $21,000 a year is that combined premium for both the employer and the employee. So now I want to turn it over to Dr. Talbert to talk about more related to APCDs.
Sure, thank you. So you've heard about what an APCD is and about some of the reasons why we need one. I'm going to talk to you about some common myths and misunderstandings related to an APCD. So myth number one is that we don't need an APCD. We already have all this data from other sources. Next slide. So, well, we do have a lot of data in place. So we have Medicare, we have Medicaid data, we have hospital discharge data, we have behavioral risk factor surveillance system data, registry data, and on and on. But the problem with those data sets is they're not linked together. And so the linked together piece, I'll give you an idea from that, is let's say we wanted to use the hospital discharge data to study opioid overdoses. And so we want to know how many people went to the emergency department with an opioid overdose. We can get that data from the emergency department data, from the hospital discharge data. But if I wanted to know how many of those people were actually in treatment for opioid use disorder, I can't get that because it's only the event that happened at that particular hospital stay. I'd have to have their insurance data to match back to that patient. Or let's say I wanted to know if that patient was actually on licit or illicit drugs when they had their overdose. Well, that data would come from a different data source that's not included in their insurance data. So once you have all these data sets linked together, you can answer many more complex questions that you can't answer without it. Next slide. Myth number two, APCDs are a partisan issue. Go to number three. So, well, that's a good question. But actually, if we look at the map here, these are current APCDs around the country, you'll see that they did start with the kind of the left coast out there with California, Oregon, and Washington, and New York in the Northeast. But more recently, we've had Texas, Florida, Georgia, Arkansas, Indiana, all within 2016 to 2020 and 2021, pass APCDs in their state. And the reason they're passing these things is because they want to lower the healthcare costs for people in their state and get a better idea of the quality of healthcare that's delivered in their states. Next slide. A couple of use case examples here just from some of these states. Arkansas in 2017 used their APCD to study medical marijuana, a growing use case in many of our states. Florida's APCD is really focused on transparency measurement. They've got websites for consumers to use to look at healthcare quality, pricing, and health outcomes. New Hampshire's insurance department is using their APCD to revamp its network adequacy requirements. Texas APCD has a number of issues that they're focused on, and they're rolling out a lot of programs around value-based purchasing and value-based care delivery. And then Utah uses their APCD to create dynamic quality measure comparisons that they use in maps, and their data is available for download across the state. The next one, number three here, APCDs are used to regulate and cap commercial prices. APCDs don't have the authority to regulate or cap prices. Some states do cap prices. Montana, Oregon, and Washington have current programs. Those programs were enacted by their state legislature, not the APCDs. APCDs only provide data and information that can be used by policymakers. APCDs also have comprehensive data governance requirements that govern how the data can be used. Here's an example of the data governance from Colorado. You can see it's pretty complex. It includes reporting relationships to the governor and the legislature, to the Department of Healthcare Policy and Financing in Colorado, as well as there's an appointed APCD advisory committee that consists of the members that actually submit data to the APCD. So people that will submit data have a seat on that advisory committee. There's also a data release review committee that anything that goes out of the door has to be recorded and go through this committee to make sure it meets one of the appropriate use cases for the data to get out the door. Next slide. Myth number four, APCDs violate patient privacy, but patient data at risk of data breach. Well, APCDs follow rigorous data procedures just like most other health insurance or healthcare providers do. They comply with the HIPAA, HITECH, National Institute of Standards and Technology reporting. The data is encrypted. Submissions are sent over encrypted connections. Personal identifiers are removed and replaced with encrypted identifiers as soon as they're sent to the data source. So this is important so that any data in an APCD is not going to contain individual identifiers. It has encrypted numbers that allows that data to be linked across data sets, but it doesn't allow any identification of that particular person. Other identifying information like age, zip codes, and small data are suppressed sometimes so that makes it harder to re-identify patients even if you don't have their information. And then also this last point here is data release follows data use agreements generated from the data governance process. The only data that gets used is what the committee that governs the APCD approves. APCDs report inaccurate data and do not give submitting organizations opportunity to correct errors. Most APCDs use a common data set that's called the All Payer Claims Database Common Data Layout. This helps ensure harmony and harmonize the claims data across states. If you're an insurance provider that the 28 states that have APCDs now, you can submit the data in the same format you do in all your other states that would be in any of the states. It makes it easier on them to generate their processes to do this. They also have workflow where data is submitted. Data then gets loaded into the system, sent back to that provider to look at to say, does the data look correct to you? They get to sign off on the data before it gets used for any kind of research and reporting. So these data submissions follow this prescribed process, which allows checks, validation, and testing. The last slide I want to talk to you about, or last couple of ones here, is, well, what are the elements of a good APCD program? So if you look at the purpose here, we've got kind of 4 or 5 bullets. Understanding healthcare costs and utilization trends in treatment settings, providers, and modalities. Inform state healthcare planning and targeted populations. Support research. Evaluate the effectiveness of care programs. And improve accessibility, adequacy, and affordability of healthcare. The scope, most require all state regulated payers to participate, and there's an opt-in for those self-insured and ERISA-governed plans. Of states that do this, they get about 75% of their or more of their states' ERISA plans to voluntarily submit their data. Governing data body and oversight. So they designate a qualified party to implement, operate, and maintain the APCD. There's an established rulemaking authority that goes with that. And there's an APCD advisory council that consists of stakeholders, consumers, hospitals, insurers, and researchers. Privacy and confidentiality, as I've already mentioned, is governed by all the federal rules that we maintain for security of healthcare data. And then funding, we want to create a fundable model that is sustainable. And this involves federal funding, involves grants, donations, and user fees. And again, we're not the first one to do this. They're in 28 other states, and we have some that have 20 years of time that we can look at how they've managed their program and run their program over those timelines. I'll turn the last slide over to you, John.
Okay, thank you, Jeff. And so really, to sum it up, as we think about moving from our current state, which is a system that is siloed, it's opaque, it's unsustainable, and how we think about moving forward to a time where we can really quantify improvements in our health at both the individual level and a population level. And to do that, the APCD we talked about as a foundational resource and tool to help do that. This is not a new journey. We've been exploring this journey at least 5 years ago. Dr. Alvarado started this process. We've had multiple discussions. We had a work group that included all stakeholders around the state for over a year and a half, trying to sort through all the issues that needed to be addressed, including privacy and security and all of the perspectives from the different stakeholder needs. And we reached a point now where we're asking you to consider putting this resource in place because we are well behind other states. It's a time where data is significantly increasing. We need to have a resource to help utilize it more effectively. So thank you again for your time today. And we'll take any questions you might have.
Got a question or multiple questions from Representative Bray.
There we go. Thank you all. I've had a couple meetings about this in the past, and the idea of the program I can kind of understand and kind of get behind, but the devil's always in the details. So who would maintain the database, who would have access to the information of the database, who is responsible for reporting the information that's needed? Are we going to put additional burden on the healthcare system? You know, when we constantly hear, you know, some of the biggest reasons we're losing physicians is because of the regulatory reporting requirements. So who maintains it and who's required to kind of weave through all the red tape?
Yeah. Thank you for your question, and I'll start to answer it, and there may be some additional information. But first of all, I'll start with the providers themselves. This should not place any additional burden on the part of the providers, because this really they've already submitted their claims. The part of the issue with the claims themselves is they don't get paid unless they submit those to begin with, so they don't have to handle it again to get it to the database. The issue relative to thinking about things like privacy and security, who manages the database, how is it, what's the operational processes? Those are all things that are established as we work through the various pieces of it, including the governance that Jeff was talking about. Some states put it in a governmental entity. Some states put it in a quasi-governmental entity. And so those are things that would need to be worked through. And a lot of those questions are vetted as you think about where the funding might come from and how to optimize the funding levels that are available. Was there a question I didn't answer there?
When I go see a doctor and I'm referred for X treatment, you're telling me that when the doctor submits for reimbursement for that claim, whether it's to Medicare or through private insurance, so it'll be the government itself, CHFS or Medicaid or whoever, will have to report that, or the insurance companies.
That's correct. So is there a question follow-up? Okay, yes, the claims themselves are already submitted to, it may be Medicare, Medicaid, insurance company. It could be through a self-funded employer who still has an insurance kind of, or a third-party administrator that processes that. But that data then all resides in those third parties who would submit the data from their database.
Okay. Just a couple follow-ups, if that's okay. In other states that have implemented this, what kind of cost increases have we seen because of the reporting requirement? So I would imagine insurance companies or the cabinet or whoever would have to hire additional people to fill out these reports and to compile all this data.
We have examples, and actually there's an all-payer claims database council that tracks all of this at a national level. But what I can tell you is that the funding to establish an all-payer claims database, particularly in today's world where a lot of the original hurdles and friction points about obtaining data and transferring data are really significantly lower than they were before. The general answer is we're not talking about increasing a cost burden either on the provider side, the system side. There obviously will be some operational costs relative to storage and managing and analyzing the data, but that would be all part of the cost structure of the APCD itself.
All right, and then just two quick follow-ups. So who's going to audit this to make sure the data that's collected is correct?
Yeah, the auditing, Jeff, you want to talk about the data?
Sure. So most other states have a standardized process that comes from this APCD council that it determines the process of what data gets submitted in exact format, how that data then gets validated and checked, and then sent back to those providers to then say, yes, this looks like what we sent you and what we think it should be. So there's this check on what they submitted was actually correct before it gets used.
Okay. And then finally, I guess I take issue with the idea that because Kentucky doesn't have this APCD is why we rank so low in these healthcare metrics, when we know one of the biggest, if not the biggest issue facing Kentucky is obesity and substance abuse, whether that's tobacco, alcohol. But, you just look at obesity and you can tie that with, to diabetes, heart disease, the list goes on and on, cancer. But we've got all this data already, and it doesn't seem like we're making any ground in these areas. Because, we know the obesity epidemic's kind of why we're seeing increased cost of care. Even through COVID, it was the number one comorbidity in determining, patient outcome. And we see that all across
Right.
So we've got the data. I guess I'm curious to see, with that and knowing that we've not done anything before, how is this going to change with a APCD?
Yeah, good.
I think that's an excellent question. And the biggest component of the answer is, yes, we do have data across the state, but we have pockets of data, and that data is not aligned. If I'm a self-insured employer, and I'll let the gentleman speak to other issues, but if I'm a self-insured employer, I own my data, if you will. I have a self-insured plan. If I have a fully insured plan, I don't. But even that self-insured versus fully insured plan, we're looking at pockets of data, and we're not able to look at it holistically because some of the issues, obesity is one of the Kentuckiana Health Collaborative's focus areas this year and for the next couple of years. Obesity is a disease state, so we have to deal with the stigma, but obesity also may have issues with where people live. Can they get to the doctor? Do they live in a food desert? And we don't really understand all that unless we're able to look at information about our state and our communities holistically. And that is what some of the other states that Dr. Talbert shared, by looking at these larger areas. SUD was the Florida example, I think. They were able to really tell where the really bad areas were, and they could hone in on that and start making significant changes. So I think putting it all together is the key.
I'll just add one more piece of that, and that is if we know where the problems are and exactly where they are, then we can enact or we can think about what program can we put in place to try to address that problem. And then we can measure and see if does it work or does it not work. Otherwise, we put programs in place now. We don't have any really way to tell how well they work or don't work. And so it makes it really hard.
It appears to me the problem's everywhere. It's all across Kentucky, and particularly in rural Kentucky. And I'm just, maybe I just need to meet with you all after this so you can kind of explain how, once we have the data, how it's going to improve anything, because we've had the data for years and we've not done anything with it.
Well, I think that's part of the whole point, is we've had data. A lot of the data is very retrospective. It might be a couple of years old, for example. So looking back 2 years ago and seeing what happened then doesn't help me today. Also, it is full of a lot of gaps, as Jenny was saying, because if we're trying to understand what's happening at a local community level, we may know what's happening maybe in some of the Medicaid patients, maybe some of the Medicare patients, but it's all very fragmented. So we're trying to make assumptions again. When we talk about assumptions, let's quit making assumptions about what the issues are and where we can develop pointed strategic plans. Let's let the data help drive that in the most comprehensive way, because we know that at least 80% of what drives health outcomes has nothing to do with what we're doing in our health system today. So we're just treating the symptoms rather than addressing some of the core drivers of that, whether that's food or transportation or housing or our social environmental factors. And so as we think about what those gaps are and how we can fill those gaps and understand more completely with the data, the more targeted we can be.
Three more questions. Representative Roberts.
Thanks so much for this presentation. I'm sad it came so late and so many of our colleagues are gone because I think it's a really important conversation. I'm glad we're considering it. I just wanted to start by letting everyone know that NCOIL passed a model act in Minnesota just a couple weeks ago on this subject, so it's something my colleagues may want to take a look at since we all respect that organization. Could you all just talk a little bit more about this from the consumer and the patient side? And I'm very familiar with the CIVIC program in Colorado, which I tend to think of as sort of a gold standard for this. So could you just talk about how these can help the consumers? And then to the previous question, I think there's a real opportunity, especially in the Colorado model, for facilities and for physicians, because there's a rating system built in there so that patients not only see cost, but they have a better idea of how good these clinics actually are.
Sure. So a lot of the APCDs do have quality systems that, and actually pricing systems and cost systems as well. But the quality ones seem to be the most prevalent across the different APCDs, where you as a patient can log on and see the quality ratings of all different types of providers in your area. For pharmacy, for example, in the Florida system, you can log onto a web page today, look up a drug in your county, and it'll tell you all the prices at the different drugstores in your county and how much that costs. Now, it doesn't have your insurance data if you have insurance and how that might change the price, but at least it has those list prices across there like that. So I think as a patient, you do have access to some of those tools to help understand the healthcare marketplace some. But then also you have the patients will benefit because their employers are going to be trying to look at how they invest in high quality care and avoid low quality care, so that your patients will end up having to pay less for their premiums for their health insurance, and while everyone's health gets improved overall.
Representative All.
Two quick questions. The data exchange, is the data coming from the Optums and the insurance and the providers of the world? Is it coming through an HL7 data feed in most states?
So HL7 would be clinical data, right? So claims data are what's called HIPAA transaction sets, right? So HIPAA transaction sets are what defines the layout of the data set itself that insurance companies use.
Mm-hmm.
So it is not an HL7 feed. HL7 would come from an electronic medical record, for example.
Okay.
However, the HL7 data feed could then be linked to the claims data with the HIPAA transaction sets, and that's the whole point, because as you begin to integrate those sets, then not only can you see what happened, let's say you had an office visit, you could actually see here's the blood pressure, here's the blood sugar, here's elements of what occurred at a more granular level. So that's the beauty of beginning to link data sets together.
And my point, the reason for asking that to the gentleman from Rockcastle's comments and questions earlier, is I don't envision that anybody would be filling out paperwork for these reports.
No.
It would be set up in an electronic feed
Yep.
over the integration to automatically transport this data to the data set. So
Absolutely.
there would be a little bit of work up front to establish that feed, much like an HL7 feed, but once it's established and tested, it's there and it's working.
Yes.
Other states, we talked about other states adopting this model and similar type legislation. And have we seen better health outcomes or improved health outcomes in these states that have adopted these?
I'll go first. There are some focus studies, like for diabetic patients or for hypertension patients, where they put a program in place and then put an intervention in place to actually address the unmet needs. And those have shown some good success so far.
That's basically what I was going to say. You can see those areas where you can hone in, like obesity, and focus in on a program or a project, and you can see success. But as I mentioned, the 10 states that are very healthy are also states that have APCDs. That's not a direct, I'm not saying it's a one-to-one, but what I am saying, when you can understand the data, you can work toward better health outcomes, which is what Dr. Talbert basically just said.
Thank you.
Representative Lewis, this will be our final question for the group.
Thank you, Mr. Chairman. A comment and a question. Thank you all, first of all, for presenting and also taking time to sit down with me and really walking through this. I think this has a lot of potential, and I especially appreciate one of your last slides, the elements of a good APCD legislation. That being said, I think there's a lot of questions as well. So, like, I'm in pharmacy space, so PBM, spread pricing, drug rebates coming back. I think we really need to look into that and to actually dive down to find the real cost. My question, though, and I'll be brief, is where does DOI land on this?
So DOI has been serving with this informal working group, I guess, for about a year and a half now. And we've come together with all the other stakeholders and expressed our concerns and raised questions and gave the answers to the pieces concerning the department. I feel that internally, this claims data would be beneficial to us as well. And so we are here and happy to take any questions as our part of the ideologies of what this would mean for the department's involvement, I guess.
Thank you. I just think we have a lot more to dive into. I hate it came towards the end of the committee. Looking forward for future discussions.
Yep.
Thank you.
Thank you.
We did have one person sign up that wanted to speak as a response to some of this discussion. Jim Musser from the Hospital Association. If you'd come forward, Jim. Give you about 5 minutes if that'll work. We have run long today, and I apologize to everyone for that, but I think these were all very worthy topics that needed to be addressed in the time that we find ourselves in right now. So, Jim, if you would just introduce yourself for the record, and then you can proceed with your comments.
Good morning, Mr. Chairman, committee members. Thank you for allowing me to speak, and I will be mercifully brief. I will say my very first job out of high school, while I was getting money together to go to college, was filling in on the teller line at my community bank, the Kentucky Farmers Bank in Catlettsburg, Kentucky. And so the things that I heard this morning in the other presentations were very enlightening and certainly made me think about things that I was seeing. And, not that they need my endorsement, but the community bankers really are the backbone of the local community. And it was very gratifying to get to hear that. On the topic of the all-payer claims database, there's no question that data is useful, and there's certainly no question that the folks seeking an all-payer claims database want better outcomes for our patients. Everybody does. I can't imagine that there's anybody in this room that doesn't want to improve health here in Kentucky, and that is certainly why hospitals exist. It's our mission to restore health, to preserve life, to bring new life into the world. And so you would think we might be at the forefront of this if an all-payer claims database was the answer. But it's kind of a solution looking for a problem, because it is not a mythology that there's plenty of data already available. If you want to know how Medicaid is spending money, the data is already there. The Cabinet for Health and Family Services actually has a web page with data that they've been collecting in collaboration with the hospitals for basically 20 years. You can see KRS 216.2920 has them maintaining a database that has millions of records in it. It's de-identified health charges. It's from hospitals, ambulatory centers, and I find myself in the odd position of speaking on behalf of the managed care organizations. You really don't see the providers and the MCOs on the same side too often, but they're providing in excess of 75 reports a year based on the claims that they're getting. So the Cabinet has all of that, and it's in a format that really you can access. If you want aggregate data, they'll give you that for free. And if you want the data sets, nonprofits can buy it for $500. And if you're a for-profit organization, it's $1,500. I think it's probably important for you, excuse me. This is allergy season for me. I don't know if it's ragweed or what it is, but I'm not contagious. But I think it's probably important for you to know that KHA does polling from time to time, and we polled on the question of, as you saw in one of the slides, patient records being turned over to a government agency, and your constituents won't thank you for turning their information over to anybody other than their doctor. There are costs involved with what we're talking about. there's not a direct correlation between healthy states and an APCD. Not saying that having data isn't helpful to making policy. It is absolutely crucial to making policy. This just isn't the right way to go about doing it. If you want data, it's already there. Adding another layer of bureaucracy, adding more cost, and I would disagree with Representative All just a little bit. It's not just the upfront. There are ongoing costs for the state in maintaining the databases. So adding another layer on doesn't really make much sense. APCDs don't necessarily give you any more transparency than the federal government is already requiring. Hospitals, I can't talk to doctors and pharmacists and dentists, but hospitals are already federally mandated to share 300 shoppable services so that people can compare prices. There are charges for every service and every item that the hospital offers. The negotiated price with each payer for each of those services and items is on those websites, and the discounted cash price is on there. So there's plenty of transparency. Quite frankly, the problem in the shoppable services really is that there's not much incentive for the insured person to do the shopping because the savings simply goes back to the insurance company. I'm not incentivized as the insured to shop because the savings, if I get savings, is simply going to accrue to the insurance company. So there are all those things that are involved. So I think we ought to be very cautious going down this road. Again, we all want to see those good outcomes. It's not something that any of us would disagree about. I've worked with Ms. Goins and many of the people sitting here behind me. Their intentions are all good, but the hospitals think that this is probably sort of a solution searching for a problem. The data is there if you want it.
Representative Roberts.
Thank you. Thank you for being here today. I'm just going to push back a little bit on that last statement that you made that patients aren't incentivized to shop. I'm a small business owner. When I first moved back to Kentucky, I had to buy my own policy, which had a really large deductible. I'd be incentivized to shop if I was going to have a treatment or procedure that was less than my deductible. I'm still incentivized to shop if I have co-pays. So I think that I love the idea of the shoppability in the future of this. So I'm just going to give you a little bit of pushback there. If I am mistaken, then please correct me.
Yeah, I don't think we're on different pages, Representative. I think it's a case of who benefits, who gets the savings. Once upon a time, I was self-employed too, and you're absolutely right. The insurance costs for the self-employed certainly make you want to shop. Excuse me, I'm so sorry. Certainly make you want to shop and make sure that you're getting the best bang for your buck. I just think as it's currently set up, it's really not an incentive so much for the insured person. If I'm on my employer's plan and I'm not going to see a direct benefit, but the insurance company is, that's a very different set of incentives.
And I think one of the keys in this, Jim, you mentioned the Medicaid data being available, and I certainly think that would be a good data set, but as has been stated previously in the conversation, you're missing a big portion of the data if you're just looking at Medicaid data because you don't have the private payer database, you don't have the Medicare data in that, all in the same location so that it can all be looked at in one group. Certainly the Medicaid data is important, but I think the other data and it all being housed together so it could be looked at is a valuable part of the plan.
I certainly understand that position. The state doesn't spend money on Medicare or private insurance except for your employees. It spends billions on Medicaid. That's really the key. And there was a little bit of a misnomer in one of the slides. It said that Medicaid only covers people who can't afford. It also covers a lot of elderly people because there are dual eligibles there.
Any other questions? Seeing none, Jim, thank you. Thank you to all the other presenters today. Do I hear a motion to adjourn? Second. All in favor?